The IRS officially kicked off tax season on January 27th. As always, there are big changes that could impact your tax return. If you're wondering how to keep more of what you make, avoid IRS headaches, and maximize your refund, you'll want to pay close attention to my presentation this evening. Suffice to say. So here are the two key updates you need to know before you file your federal and state tax return April 15th and what have you. So let's talk about some little bit of tidbits. Retirement contribution limits have increased, which is good. Retirement contributions limits have increased, giving you more opportunities to cut your tax bill while securing your financial future. For the year 2024, contributions, 401k maximum contribution per individual is $23,500, up from $22,500 from 2023. And your IRA limit per individual this year, 2024, is $7,000, up from $6,500. And there is a catch up for 401k savers of age 50 and above, which is $7,500 catch-up provision. Okay, so tax tip: if you have not maxed out your IRA contributions yet, you can still contribute for 2024 until April 15, 2025 this year, which is 2 months away, and potentially can lower your last year's taxable income even a little bit more. And also, IRS funding cuts and new tax laws are on the horizon, especially with the new administration, with Donald Trump. He's proposing a lot of tax cuts. With a new presidential administration in office, the IRS is undergoing major changes, not including the last few days of major workforce firing. Many federal agencies are being fired from their job. There's going to be some kind of ripple effect. It's going to happen throughout the federal government with various agencies: Federal Housing Administration, Department of Defense, and a lot of budget cuts. A lot of thousands of federal employees are being fired. Most of them are probationary workers, thank God, and some are about to retire anyway, so they're getting early retirement. So it should not affect the overall workforce, the nationwide workforce, as far as I'm concerned, in my opinion. But who knows? Too early to tell. So furthermore, the IRS is having a hiring freeze on the IRS agents, especially new agents. So maybe we can get away with more tax strategies without being audited. So they're firing thousands of IRS workers in the peak of the tax season as we speak. So funny, in my estimation. Anyway, a proposed new tax agency, ERS, that could shake up how tax collection works. That's down the road. Keep an eye on it. Possible IRS budget cuts that could impact enforcement and refunds. And if you want to stay ahead of the IRS and keep more money in your pocket, now is the time to get expert help above and beyond this evening. All right. So let's go over some miscellaneous topics. So some of you are already an experienced investor. You may own one rental or more. If that's the case, if you have filed past federal tax returns, you would know what I'm talking about. Some of you does not have a rental. Please put down on your chat box if every one of you, whether you own any rentals or not. All right. So I'm very curious to see what is the difference between Schedule E and Schedule C in terms of taxes. A Schedule E is where you report activities earning your rental income. A Schedule C is where you report activities earning income subject to self-employment taxes, such as a regular brick-and-mortar business, like a service business, or if you're in a full-time real estate, if you're flipping real estate, that is Schedule C. You're in the business of real estate, subject to self-employment taxes, which is an additional tax above and beyond the regular federal tax. For example, if you are a real estate agent, example, you are Schedule C, as a service business. Right? If you own rental properties by IRS definition is a passive activities, you report your rental income and expenses and depreciation on Schedule E, Supplemental Income Schedule, which I will go over in more detail with the tax form appeared before your screen, okay, throughout the presentation. All right? And here it is. This is Schedule E. As you can see, each time at the end of the year, after you experience the calendar year of the rental property, you will allocate, you could document your annual gross rent before deduction, right? By the way, the rent you receive from your rental property, the gross rent, a lot of you may not know that. The gross rent is subject to ordinary taxation, subject at your ordinary tax bracket. Some of you in a 50% federal tax bracket, some of you in a 20% federal tax bracket, some of you in a 25%, 31%, and 37% federal tax bracket, depending on how much money you make, right? If you make 100 grand, right, W-2 income, you're probably in a 15% federal tax bracket. You make, I'm just guessing, okay? Don't quote me. If you make 150 grand, you're probably in a 20% tax bracket. If you make $200,000, by the way, when I say you could be a single filer or you could be a married filing jointly. When I say you, is your entity, you're one person or two-person married couple, all right? So if you make 250,000, for example, you probably in the 25 to 30% tax bracket. If you make $300,000 W-2 income or self-employment income for that matter, you are probably 31% tax bracket. If you make about 300,000, or 500,000 or more, you are the maximum highest federal tax bracket of around 37.5% federal. If you live in California, your maximize state income tax, the franchise tax board is, I believe, 9.3%, right? Think about it. If you make like 400K, 500K or $600,000, right, income, which a lot of people in California make that much money, right? Especially in a high tech, in Silicon Valley, people make that much money. Right? So you are in the 37.5% tax bracket and a stake of 9.3. We're talking like almost 40 something, almost 50% of your paycheck go to the taxing authority. Having said that, remind me, of course, I don't need reminder. When we discuss toward the back end of the presentation, when we discuss the real estate professional tax status, is ideal suited for someone who has very high income. So by qualifying as a real estate professional status, you can have unlimited passive losses, unlimited real estate paper losses to offset against active income. And that way you can substantially, significantly save tons and tons of taxes against your W-2 marginal AGI, adjusted gross income tax bracket. Does that make sense? All right. But it's not that easy to qualify as a real estate professional. One more thing I want to say, you don't have to be, ideally, you should need to be very high income to maximize the tax deductions. But by definition, real estate properties, by the IRS definition, real estate properties or income properties are like passive losses, right? There are limitations, which I will go over it later on tonight. But you can only, normally, according to IRS definition, your real estate income, your passive income is only offset by the maximum of your passive losses, right? You can only, okay, understand what I'm saying? Your real estate income can only offset to the extent of your real estate expenses, your real estate passive losses. Anything, if you have more real estate passive paper losses, more than your passive income, you can't deduct the excess. You have to carry forward the excess. You have to suspend the excessive passive losses on paper, that is, into the future tax year to offset against potential future passive income, right? Isn't that the ideal situation? Unless the only way your passive losses can offset against active income, against your W-2 earned income, if you use two rules, which we can go over, of course, the real estate professional tax status and the short-term rental tax whole, all right? Is this exciting? I'm trying to make a tax, which is a very dry subject, try to explain it in a non-boring way, if that's possible. You know what? Come to think of it, if you have a regular CPA, certified public accountant, or a tax attorney, whatever, making this tax presentation, I have to believe they're going to bore the heck out of you. They can go over the technical jargon, which will fly over your head, and they can use all this technical terminology, tax passive losses, and cost segregation, and all this tax terminology, which is sounds impressive, verbally speaking, but does not articulate to the layman. You guys are laymen. You know what a layman? You got regular investors. You're not tax expert. Some of the terminology are foreign to you. So I will do my best, because I'm not a licensed tax advisor, to explain these strategies to you tonight in a most understandable, most common sense, most fundamental way possible. I'm putting myself in your shoes as a beginner investor. No, even if you have 2 or 3, 4 rentals, I believe, and you have over the past 5 or 10 years, believe it or not, you think you know a fair amount of tax strategies, but I'm going to say to you that you don't. Over the years, or the past 20-something years, when I consult with my clients, my investors, and my coaching students, you'll be shocked how little they know about tax strategies. Even if somebody owns 5 or 10 rental properties, they still do not know. Okay? Because the accounting industry they just don't know how to explain things correctly. They don't know how to speak your language. They don't know how to explain things correctly. That's the frustration, okay? So even when you hear YouTube videos about various aspects of tax strategies, I hear them, I watch them all the time. Sometimes I'm having trouble understanding the presentation by those real CPAs. But if I'm having a little bit of trouble understanding, imagine the rest of you investors, especially rookies. If you're a rookie, if you does not own a rental property, you have a steep learning curve on real estate, not just tax strategies, but buying real estate in general. Real estate investing in general, you could have a huge learning curve. Does it mean that it is overwhelming? Does it mean you'll never become a real estate investor successfully? No. You have to continue to learn, educate yourself, just like you're doing tonight. But most important thing is you cannot learn forever. I found over the past several decades of doing this that a lot of people, most people, they continue to learn, go through YouTube videos, social media, Instagram, whatever, or internet. They keep on learning, and yet they do not take action. They own no rental properties after 10 or 20 or 30 years of learning about real estate, which is absolutely shameful. I hope you guys are not one of them, okay? One more thing I want to say. I know you're learning tax strategies right now, but if you do not have any rental properties so you can learn by applying the tax strategies you're learning, and after tonight, you still do not own any rental properties, whatever the reason, you're wasting your time tonight. You're wasting your time. For you to buy at least one rental property, preferably to buy more, given your financial situation, given your capital resources available. You need to take action, take consistent action, buy as many rental properties as possible over the next 5, 10, 15, 20 years. Okay? Don't become an educator, investor, and end up having no rental properties, which the majority of you do not, will not ever buy rental properties. Okay? This is a reality. Okay? This is reality. Most people will never become real estate investor, even though they may get a PhD in real estate investing, like tonight, which is absolutely mind-boggling sad. Why? Because of fear. Most people are scared to invest in real estate. That's the bottom line. So you have to overcome fear. Anyway, okay, I digress. All right, let's go on. Okay, this is Schedule C. Now, Schedule C, again, this is it's a sole proprietorship. This is a brick and mortar business. If you Schedule C, their income The business income and business expenses is similar than with the Schedule E, but the Schedule C, you are a flipper. A flipper files Schedule C. I'll talk about flipping later on in the presentation. If you're a flipper, you file Schedule C, and if you're in the business of real estate full time, whatever, yeah, you file Schedule C, like a commission sales agent or real estate broker, like I am over the many years. All right, okay, let's continue. Is Airbnb Schedule C or Schedule E? We discussed that. Most short-term rentals will be reported on Schedule E, okay, not Schedule C. Schedule E is supplemental income schedule, which I already showed you tax form, okay? You will report your short-term rental on Schedule C only if you are providing substantial services to your guests while they stay at your property. But however, most short-term rental owners don't do this. What I mean by substantial services, you're like a concierge. You're a concierge hotel. You're running basically a hotel. The maid bring the breakfast for you. There's a front desk. You check in front desk and they give you the key to your room. Those are additional providing substantial services on your business. Then you will file Schedule C, sole proprietorship, okay, on your tax return, right? But if you are a short-term rental owner, if you do not provide substantial services, which most of you do not, then you continue need to file Schedule E, supplemental income schedule, like the form I just showed you. Does that make sense? Okay. All right. The next hypothetical question is, which is better, Schedule C or Schedule E? It's not about which form is better, but which form is the right place to report your activity. Do what is right, and not it's not you pick and choose. There's rules you have to comply with. So who is eligible for Schedule E? Landlords who own property producing rental income will report to rental Schedule E. There's one more Q&A people do not know. Sometimes I get this question over the years, like, what if I own income property, I file Schedule E, I report the gross rent, I report all the expenses, taxes, insurance, property management fee, maintenance costs, whatever, but I'm not going to claim depreciation, because if I claim depreciation, when I sell the rental property later, I'm going to suffer a recapture of depreciation. That is technically true, but I behoove you still should file claim depreciation paper loss. Because if the IRS audit you and you do not, or over the years, you do not claim depreciation on your rental Schedule E tax return, they will make your IRS auditor will make you report the depreciation, go back to the prior years and make you do that. That could be an audit red flag if you get audited as well. So what? If you sell your property 5-10 years later, you have to pay the recapture tax depreciation. But then the recapture of depreciation is a 20% tax hit. So that's a future of money, okay? It's inflation adjusted. Still, you should claim depreciation no matter what, regardless of whether you're going to sell your property later on or not. Because when you claim depreciation in the current year, you're getting the better use of the money, because you get an inflation adjusted return currently, because the future of a dollar, the future inflation is less than it is current. All right, so I digress. Let's continue. What other passive income tax form do I need to know about? IRS Schedule E, Form 8582. Form 8582 is always like a supporting schedule. It's a supporting schedule right behind the Schedule E. 8582 is, I think the name is depreciation. Okay. The name of the form, 8582, is depreciation. So whether you are a hire tax advisor, like who help file your tax return, or you self-prepare your tax return and you own at least one rental property, you need to not only file your Schedule E, supplemental income schedule, but Form 8582 allow you to track your depreciation every year, and any kind of excess passive losses you cannot claim on the previous year, it'll get suspended indefinitely in the future years. And Form 8582 there's a box, some entries in there allow you to record the amount of the suspended passive losses from one tax year to the other, so you can potentially offset the suspended passive losses from the prior years to offset against current passive income from your other rental properties. Does that make sense? Hopefully it does. If you don't get it, of course, when you get this webinar replay, you're gonna hear everything over again, and the light bulb may click. That's the value of getting a webinar replay link. I'm gonna provide to you in the next sometime next week, so you can replay this entire Zoom video. So you need more than you hear. You need to hear this more than one time to digest everything. Okay, I'm pretty certain that is my assumption, because again, tax strategy is somewhat of a dry subject. It is hard to understand if you think about it, because you guys are not tax trained. It takes years for a CPA, certified public accountant, to pass the CPA exam. You know how hard that is. It takes years of practice for them to know tax strategies. We are just simple real estate investors, but we don't need to be an expert. We just need to understand how to apply the appropriate real estate tax strategies to your unique situation. So it's important for you to have a team of financial advisors. One of them is your CPA. By the way, it doesn't have to be a CPA. There are some in California that are registered tax preparer who's more than qualified to help you file your tax return. And then there are some enrolled agent, so-called enrolled agent, people who passed a very difficult exam, who specialize in tax filing, tax consulting as well. A lot of people don't talk about it. People think only CPA can help you. No, enrolled agent, they're just as sophisticated. They have to pass a very difficult exam to get the designation of enrolled agent. But at the end of the day, most accountants do not understand real estate. I repeat, most CPAs, enrolled agents, tax preparer, or financial advisor, traditional financial advisors, read my lips, they do not understand real estate investing. You need to find a CPA or tax consultant, a licensed tax consultant who clearly understand real estate investing, who own rental property themselves. They own numerous rental. Preferably, they've been around for 5, 10, 15, 20 years. I say it again, 99.9% of tax consultants out there in the country are not qualified to handle your case. 99% are clueless on real estate investing, quote unquote, by Seewing Yee. How I know that? I've been doing it for several decades. I've been consulting with tax accountants over the years. Okay, I have worked with thousands, maybe not thousands, hundreds of real estate investors, and I go over their situation quite a bit. I do a holistic review. I mentor and guide real estate investors to buy income properties in various parts of the country for decades and decades. I'm pretty old, Emma. Sometimes I'm very old. I'm older than most of you. I'm a baby boomer, by the way. That's all you need to know. I'm a baby boomer. Let's calculate how old is a baby boomer. Oh, what year were they born? Do you know how to calculate? Oh my goodness. You notice I digress quite often because I got so much I got life experience, real experience. Everything I'm teaching you, believe it or not, even though I'm not a licensed tax advisor, is real world experience. I practice what I teach. I own multiple income properties over the decades. I bought my first primary home, 1992, 33 years ago. And anyway, long time ago, I've been a real estate investor. Then some of you have been, as a matter of fact, I used the real estate professional tax designation for several years. That was more than a decade ago. Like I said, the words coming in my mouth is real, okay? It's not theoretical BS I'm teaching you. It's real world, something that I have done personally for my own portfolio and assisting hundreds of real estate investors over many years. Okay, so can you group multiple STR, short-term rental, together if you only materially participate in one? Of course, yes. You are allowed to make a grouping election under Section 1.469 for STRs in the right circumstances, and the criteria are similarity and differences in type of trades or business, extent of common control. Look, I'm quoting you this technical codes, IRS code. I'm going to translate them into layman's term. What I'm saying is if you have several rentals, similar rentals spread out, within a geographic region, and you're doing short-term rental kind of a strategies, if you have more than one short-term rental on your tax return, you need to create a grouping election. Okay, it's technical, so you need to consult your tax advisor before you file your tax return, especially when you have more than one short-term rental. You need to create an additional form. It's a grouping election tax form. Okay, so you could document your hours, make sure they are your 2 or 3, 4 short-term rentals are part of one entity by grouping the elections, so you can document the hours, the material participation hours, which I will go over in more details later on. Okay, don't worry. All right. Some more tidbits. With the new administration and a majority in the House and Senate, big tax updates are expected in 2025. One major change, 100% bonus depreciation is expected to make a comeback. Maybe not 2025, perhaps 2026, next year. So keep in mind, this will happen. Right now, the bonus depreciation is at I believe 60%. You can only claim 60% bonus depreciation the following year, 2026, if there are no changes in the bonus depreciation rules. The next year will be 40%, the following year will be 20%, and the subsequent year will be 0. Then it's potentially all gone. No bonus as the law currently stays. But a lot of tax experts expect current administration to restore the 100% bonus depreciation. If that is the case, you will potentially receive massive tax saving opportunity for investors, because you can use non-passive losses to offset your W-2 or against your active business income. One more thing, I already mentioned this. You need to own a fair amount of rental property in order to take advantage of all the tax strategies I'm teaching you. Once again, right? If you do not own any rentals right now and you're attending this, your first motivation is to start owning rental properties. First and foremost, you buy the rental property first. Forget about your tax strategies. Just buy as many rentals as you could based on your capital resources available. I know some of you are very limited in your capital resources. You may take you a while to buy your first rental because buying a rental property would require 20 to 25% down payment, right? It's not that easy to come up with that vast amount of money. Most Americans are living paycheck to paycheck, right? Or in debt. Okay, so you have to know who you are. What is your financial situation? What is your money management skills? And all that if you want to become a successful real estate investor. Okay. So what is the best way to generate non-passive losses? Again, I'll talk about it very soon. Use the STR short-term rental loophole, because you can do it part-time and you don't have to work full-time in real estate or use questionable strategies in order to qualify for the short-term rental tax loophole. Okay, and I'll show you more details very soon. Even if 100% bonus depreciation does not return, this remains the number one tax strategies for high income earners in 2025. Okay, even though I mentioned short-term rental, I do not own any short-term rentals, nor I ever want to. You guys are thinking, why? Because I don't want to do the work. Owning one STR or more than one STR, as far as I'm concerned, is a full-time work. I don't want to do the work. I want to become a lazy passive investor. What does that mean? All I buy is cash flow turnkey rental properties across many markets in the US over the decades. And I have professional property management manager for me, meaning whether myself or several hundred students of mine that I coached, that I mentored over the years, they have purchased 10, 20, 30 properties. Not all of them, a handful of them, of course, right? The majority will never buy anything. The majority of my membership, they will never buy rental real estate because they are the 1,000 reasons, excuses. The main one is that they are too scared. Okay, all right, nothing I can do, human nature. But the handful that purchased, that I consulted, the risk investors over the years, they have purchased 5, 10, 20, 30 rental properties, such as my portfolio. And they spent a total, the drum roll please, of 1 hour per what? Per day? Per week in managing their real estate portfolio? Or what is it? And the answer is 1 hour per month. I say it again. Many income property owners over the years have owned 5, 10, 15, 20 rental properties. They only spend 1 hour per month in managing the real estate portfolio. What that 1 hour consists of, mainly collecting paychecks, rental income into their checking account. They spend 1 hour counting the number of multiple streams of income entering their checking account or whatever account they designated. Okay. So you make money when you are sleeping, when you buy turnkey, cash flow, low cost, great properties in the best real estate markets in the country. All right, enough said. Again, buy long distance, buy remote, buy turnkey, buy new construction, cash flow rentals. Okay, 20 to 25% down payment in cash flow.